It's not every day you get to sit down with the founder and co-CEO of a company that is one of the largest fintech platforms lending to SMBs in the US. Sitting down with Ryan Rosett, I learned a tremendous amount about what it is to grow a business for 14 years and to do it at the scale that he is. It's quite remarkable. He truly is in the top 1%. His honest humility of what it is to build a business like this and how they like to operate, leveraging of AI, and so much more is all covered in this episode. If you're a founder looking to grow your business, this is the episode for you. So strap yourself in and enjoy the session. All right, guys, welcome to another episode of Successful Scales. You are all in very good stead here because I'm fortunate enough to sit down with Ryan Rosett, who is the founder of a business that I actually think the stat is that if your business has been running for more than 10 years, then you're in the top 1% of companies that exist globally. And it's not just that he has been running this business for an extended period, but he's doing some pretty exciting things and helping I read actually before we jumped on over 60,000 companies. And so I don't want to butcher it. I'm going to hand it over to you, Ryan, to give a much better introduction than I ever could.
All right. Thanks, Yanni. I appreciate it. Thanks for having me on your podcast. So again, my name is Ryan Rosett. I'm co-founder, co-CEO of Credibly. We're an SMB small business lender in the United States. We lend from $5,000 to $600,000. We typically take less than 2 hours from application to offer and fund same day. We've been doing this since 2010. I have a partner, Eden King, and we're based out of Detroit, Michigan.
Awesome. I love how succinct you were in giving sort of the value proposition. And I think it says a lot for anyone listening out there to be able to actually clearly articulate in a short period who you target and how you support them. I think goes a very, very long way in having that degree of clarity. One thing just to start off, and it's a bit of a curveball, but one thing, hearing that you have a co-CEO, and I've seen a bit of that, particularly in the aggregated space. I saw a bit of that, but I'm just curious to understand how that evolved, how that came to be, and how do you sort of manage that relationship at the top?
Yeah, it's a great question because oftentimes it doesn't always work. It works for us. We divide and conquer. I mean, I oversee really the revenue side of the business, sales, origination, product, and tech. My partner oversees operations, legal, and which is like a big part of our business. We both kind of co-oversee the finance part of our business, but it very much works for us. He has much more of an underwriting background. I'm more on the sales end of the business, and we complement each other. And do we disagree? Of course we disagree. But do we come out of the room making like a decision, or does he defer to me on areas that I think I have a little bit more domain expertise? He does, and I do. I have the same deference to his expertise on the ops side of our business.
Yeah, and just always interesting to look at businesses, and like I called out 10 years in, and what you guys have achieved is it's remarkable, honestly. So having really strong partnerships is definitely keen. To be able to have a co-CEO probably speaks volumes to sort of your ability to achieve that. I have so many questions for you, Ryan, and that's the truth, and we have a limited amount of time. So I just want to sort of dive into some of the key things I think that will get or resonate with the audience. The first of which is that we sit in such a changing landscape right now. I don't want to call it a buzzword because, there's been times whereby there's been these moments in time where the whole landscape has shifted, the .com boom. Maybe let's not talk about Lehman Brothers. That wasn't good. But there's been moments in time where you've just seen these very material shifts. And so I'm just curious from generative AI and AI and LLMs in general, what, if any, implications do you foresee happening toward the lending space and even the businesses that you're supporting?
So, it is like a very interesting time. I would say that, from where I'm sitting, I think, it's as transformative generative AI as like, when the internet was sort of introduced to us, and it seems as if it's like grabbing hold much quicker because like in the days when the internet was launched, I mean, I remember having AOL, and you kind of sat within like an AOL environment, and I thought it was like super cool that I could get the weather forecast on the internet, and that was like what I was using it for mostly, or like these instant messages. Now, you can see like how transformative generative AI is, how we're leveraging it. We have 2 patents that we secured. They're really their workflow. So it's the way that I'll give you one example, like industry types. So it's not simple to identify an industry. So, and I'll use a simple example of like an electrician. It could be ABC electrician, and you don't know whether they're actually coming to your house and actually fixing some electrical issues. You don't know if they're selling supplies. You don't know if they're manufacturing electrical, just by the name. So, and they're all very different, the way that you would identify their code. So we built a model that really kind of went through the large language models and made a determination at like 95% or above accuracy for the Nixus code, which is like there's a SAC code and there's a Nixus code. Nixus code is like more granular. And before we were using humans to do it, and we were at about a 64% accuracy on the business on identifying that. Plus, it took humans to go through it, do web searches, and kind of say we think this is this type of industry. And why that is important, it allows us to price a deal appropriately. So like we look at affordability as a key component of how we price or make offers to businesses. And certain businesses have different margins. Grocery stores have like much smaller margins than other types of businesses. And so like knowing their margins allows us to really price the deal appropriately. And what we try to do is give like a max approval. They don't have to take the max, but we want to say, hey, we approved you for $100,000. And they might say, hey, we only need 50. Great. Then take 50. But we're just saying we based on your cash flow, this is what we believe you can support. And to us, it's important that we get paid back. It's important to the business that we don't drown the business with debt, because that's like very important. They can only like support a certain percentage of their gross revenue to pay us back, or we feel that it's prudent for the business to take money. So it's like we balance a little bit of both. Like of course, we're a for-profit company. We want to be paid back. Okay. Like, I mean, that is like the nature of like how we price. And, so I don't want to sugarcoat that, but we also want the business to be successful. And we want to make sure that they can afford the payments that they're signing up for. So like, that's an example of how we're seeing generative AI really work. And we were able to eliminate 25 heads by just that little piece of technology. And so there's like so much more in there. And these employees were all, they were full-time employees in India, but so it's like, I just want to clear, like, because there is a feeling out there, I think that, that AI will like eliminate all jobs everywhere. I don't think that's the case. I just think it's going to make people more efficient, and people will be used in like smarter decision-making processes where maybe the large language models aren't there yet, but maybe they'll get, I'm assuming they'll get there and be smarter than us soon. So.
Yeah, definitely. It's definitely, a thing that I take very seriously, because that is literally our business is predicated effectively on geolocation-based arbitrage. And so, looking at it, what I'm seeing, at least in early stages, is that in most cases, you're getting a fee whereby you're able to level the playing field, but it will come likely to a point that you really consider what jobs therefore become redundant as a result of it. What struck me as really interesting when you're sort of giving your explanation around the business and also just reading the profile is that you are customer obsessed was what I read. And to be able to turn this around in a 2-hour period from the audit of, is this a company that we can lend to, and having that level of accuracy, I can only imagine speaks volumes to the outcome of the customer experience and also your ability to beat out competition. If someone's taking a week or 2 weeks and you can do it in 2 hours and there's money in your account, it's significant. How did you guys get there? Like, was that a core driver of focus for the business? Was it about speed? Was it about quality? Like, what were the steps that got you there?
So, I want to just say that there were many times, like when we ran the business, that it took us 48 hours to get an approval. Okay, just because we were like inundated with applications and like we weren't able to respond quick enough. So what we did was we broke out our tech and we broke it into 4 different chunks and then we automated certain pieces of like the underwriting process to allow us to get to the point where we are. 2 years ago, we made it like sort of a company mantra to really because like we've had other years that we're like, this is the year of portfolio management, where we're spending a lot of tech resources on the portfolio side of the business and like improving that. The last 2 years have been just completely customer-centric, customer-focused, user experience, simplifying how a customer interfaces with us. And that has really sort of, I don't know that will ever go away, just because it is the core of our business. The customers is what makes us successful. And we always want to be customer centric. And we also want to be like sensitive to customers in terms of, what they're experiencing. So like, for example, like, if there's a wildfire in California and their business is impacted on that, we want to, we can react really quickly on the underwriting side so that we can do, virtual site inspections. Like, there's a bunch of different tools that we leverage on that front. But then I would say that if customers are impacted, we want to help them as well. So we're not being there for the customer, being there when they need us from a working capital perspective is something that we want to, we think long-term on that. It's not like a short-term game. Let's do one loan to this customer and then we're done. Like we value the customers. We have about a 35% of our customers come back for additional fundings. And that's growing. So, we think it will probably be at 40% like in the next 6 months. But it's a big part of our business is like, maintaining the customer, having a customer experience that it's a seamless process. There's we just launched about 6 months ago, an online checkout, which basically like once they're approved, they will have we give them an online checkout experience, which usually takes like 7 to 10 minutes. It's just it's a 5-step process. Where they sign the agreement, they do a biometrics where they take a picture of their face, they take a picture of their driver's license, they, answer a few questions and they get funded. So, it could be 2 hours and 10 minutes for somebody to get funded, 2 hours for the application, the due diligence, and then we give them an offer, they accept the offer, and then they go through an online checkout. So, and then I always question, just as a business owner, how fast is fast enough? And, our average loan size is $65,000. So it's not small. It's not consumer lending where you were lending $200 or $800, per loan, where you can actually just do it. And if one defaults, it's okay. A $65,000 loan is still a significant amount of money. And it's so there should be like a pause in there at some level where the customer should have an opportunity to make sure that this is something that they want. And, we certainly want to make sure that it meets our underwriting guidelines, and we feel reasonably comfortable that they're going to pay us back in a timely manner.
Yeah, I mean, that's pretty incredible just to be able to literally open an application and within 2 hours understand, if on average I can access $65,000 and go through a 10-minute process. It seems like you're very well dialed in terms of that customer experience and that journey. You're 14 years into the business, if my math, 15th year, is that correct?
It will be 15 next month, yes.
So that's a considerable amount of time to focus on, every business is dynamic and there are many, many problems, but you're effectively focused on a single problem. And that's how do I deploy the most amount of capital to the people that need it with the highest likelihood that they're going to pay us back the money, and everyone walks away in a better position than when they started. And I would imagine you've had a lot of lessons through that journey. I've got two questions for you. I mean, I've got probably a million on the back of this preamble, but two sort of questions come to mind for me. Is one, through the maturity of the business, at what stage, and I'm not talking about sort of the algorithm that you have to build in terms of the lending piece of it, that obviously has to be central, but at what stage did you move from sort of fly by night, figuring out as things going on, what's our acquisition strategy, to, you being able to very clearly articulate, we're at 35% of repeat business effectively, and we're trying to grow that to 40%. And I can only guess that which are the channels and what's converting and, the success from each stage of the funnel. Like, what was that journey like for you into that maturity? And for founders who aren't quite there, what are some of the steps that they should take? I'll start with the first question instead of muddying the waters here.
Yeah. So I would say that what in 2013 was we rolled out our first proprietary scoring model. And that was probably the most that caused the biggest transformation, I think, of our business, just from the standpoint of like how we became like a data-centric company, that we were measuring a lot of different things versus the manual process of going through. And I want to say, like, if we went back to that sort of model, I'm sure it was very elementary, like compared to like the complexity of today's models. But the start of it, and then bringing on in 2014 a data science team, and then investing heavily in data analytics to help us drive better decisions. So now, I would say across the board of our company, like from really from originations, top of the funnel marketing to collections and portfolio management, it's all data driven. So, I know you mentioned that, before, just in terms of like, key metrics and different channels and, what's more profitable, but we're constantly looking at that, and we're constantly tweaking it so that, if we see a certain segment that's performing better than something else, we'll price that. We'll do some A/B testing into that and say, hey, if we can lower the price of that, and we can drive more volume, and there's a lower charge-off rate, for this segment, and it's more profitable, we're going to try to do more of that business. So like, so we're constantly testing, and to say that like we have it down pat, it would be a lie, because we're constantly testing and we're constantly learning, and the reality is it's evolving. So there's like, there's been times where trucking, like, you mentioned the pandemic. Trucking was amazing during the pandemic, because everything was being, kind of moved around the country, and, for when, e-commerce and, things were always being delivered. But then trucking became, just a horrible industry to lend into. So it was like, and you trying to get in front of that. So, like that's an example where fuel prices and spot rates, and, where like the truckers make their money on a per mile basis, and how that, if that doesn't go up, a fuel increases, their margins get sort of impacted. So and that's just like one of, probably, 300 to 400 different industries that we lend into. So sort of staying on top of that and starting to see sort of trends early are really important. But we can't read the future. So we just like, kind of look at like the performance data. And like even today with the government shutdown in the US, there's certain industries that are impacted that are completely unforeseen to us. Like we would not have thought that they were so contingent on like government contracts that potentially were impacted by the shutdown, and they're now not getting paid. So like that I'm just giving you a very current issue that that we're always looking at, modifying, adjusting, and and this all goes into our risk models that we're constantly tweaking just to make us provide better loans to customers that are what I'll call affordable and risk adjusted.
Great insight. Yeah. I do have a second question. Just to sort of piggyback on that question. Obviously, even just listening to the situation with trucking and the government shutdown and the wide spanning implications, considerable, and no business is perpetually secured, and you have to continue to iterate. But where I was leading, or what I'm trying to sort of gauge, is again, I'm making assumptions here, so correct me if I'm wrong, if my assumptions are incorrect. But the decisions that you now make, while there might be these big fluctuations in market, you are likely looking at each stage of, I'm not just talking about the sales funnel, but the repayment rates, and each, you would likely be in a position where you're looking at analytic, performance dashboards and saying, well, from a sales perspective, we got this many MQLs, and that these were the sources, and SQLs, conversion rates and percentages, and you're able to sort of micro dial in the decisions and say, well, if we're just able to increase our conversions from MQL to SQL by a 5%, the flow-on effect is an added $10 million of revenue and $2 million of net profit to the business. And so let's attack this specific area. And so looking at sort of the evolution over 15 years, we're 6 years into our business, and now we're getting that level of clarity for the first time. We had access to the data, but we weren't actually activating it to a point where I can tell you now, to a 80, 90% confidence of where our leads are coming from, what the conversions rates are, what my team needs to work on, et cetera, throughout the business. And for a founder who's going through this journey, whether they're funded or not, you don't often have the luxuries of setting up these things, before the fact. It's usually after the fact. And I'm curious to understand, what were the triggers, or at what point in the business's 15-year life cycle were you able to get to, a level of detailed insight? And, for any founder listening in today, how significant or how important do you feel that is, or not, to get ahead of that curve?
So, I would say it was probably, to the point where we had, really good insight into like, the entire funnel. I would say it just gets better and better. So but to the point where we were making like real decisions based on data, probably 7 years into the business. So, 6, 7 years where we were, I would say earlier where there were certain decisions being made, but like across the entire business where we weren't like, we weren't just like reacting, we were being a little proactive. That was probably, 7, 8 years into the business where we could like proactively make changes in anticipation of something. And sometimes we were wrong. Sometimes we would make a change believing something was like going to occur, but like again, we're not economists. We read a ton, but like that doesn't necessarily mean we're reading accurate. We read the internet, and we read trustworthy sites, but like it doesn't necessarily mean they're accurate. And so sometimes we're making changes based on beliefs that the management team has, and I would say for the most part we've been fortunate that we've been correct more than not, but there's been times where we've lost business, where maybe we've tightened up because we've anticipated something was going to occur and it never happened or didn't materialize. And so like those are just, that happens, but the good news is we didn't, sometimes you go too long. You can think that like the wind's in your back and you should open up and, and something changes. And like, that's not what we've done. Like we're generally like, we're risk takers because of the business we're in, and we're making decisions in 2 hours on unsecured basis. So, like by nature, we're risk takers, but like on the same token, we try to there's a level of conservativeness in what we do.
Yep. Yeah, totally. I mean, that's that, that I would imagine. And I'm so keen to dive deeper into this topic, but I'm just cognizant of the amount of time that we still have up our sleeve. And I got 2 last questions for you, and I think it'll round us out here. So switching topics a little bit and throwing a bit of a harder question at you. It's a very hard thing to sum up 15 years of experience in a single business. But when you look at the journey that you've been on over the course of this time and the things that you've done, what would be, I would say, the 1, 2, 3 key learnings or things that, had you have known them earlier, you would have behaved differently, or the things that maybe now that you know them are sort of setting you forth on a path of, I make many of my decisions based on these realities now?
So, I would say one thing we do is there was a couple key things. There was, the way we operate our business is we leverage something called EOS, which is it's called Entrepreneurial Operating System. And it's just, and there's many different types of it. So I'm not like necessarily endorsing this over another, but what it does is it allowed us to
Gina.
be very, yeah. Okay. He's great. So but it really helped us stay focused. And like where we were in the beginning, an opportunity would pop up. We might run at the next shining object. And, now we're just like laser focused on what we want to accomplish quarter by quarter. And we set like sort of our, 3 to 5 year goals as well. So it's, I would encourage anyone in a business, like, starting to like find a way to like really hone in and create accountability for the entire organization, because it's just like, it works and it makes my job a lot better and easier. I'd also say like, another key point was just having, I enjoy having people who are much smarter than me working with me. And that's been amazing, because like, I don't want to be right. I mean, I'm okay if I am right, obviously, but if I can be proven wrong, great. So I actually enjoy the challenge of having people around me that are constantly challenging, what we all are trying to accomplish, and we're all in it we all have like the same common goals. We're all going in the same direction. So I would just say like, those are some of the things that if I were to restart a business, I would have those things lined up as soon as possible. I mean, like the vision of the company, and, we've stayed very focused on one thing. And we really haven't allowed, business insurance to come in, or other pieces that have like, nibbled at us in the past. And we just said, you know what, this is what we're good at, and we're going to be really good at it. And we've stuck to it. And I think it's served us well, because it's like, you can go to some restaurants, like Cheesecake Factory figures out how to, you may not know this where you're living, but they have a menu, what looks like a dictionary. So they have like everything on them, but that's not us. We serve one thing, and it's small business loans. So it's really like, and we want to be really good at it. So, you can't be all to everyone, and we've really just stayed true to like our business.
Great advice for anyone listening into that. We run on EOS. I mean, I would then ask, with you having a co-CEO, who's the visionary, who's the integrator, but let's not go down that wormhole. I want to ask, with the conversation that we've had, and I wish it were longer, are there any things that I should have asked you that I've missed out on? Is there anything that we should have spoken about that we've missed here?
It's my favorite question. It's a question I always ask after everything. No, I think you've covered like the generative AI, and like, I would just say like, where things are going in this business, I just think it's going to be, less. I just think, when I think about lending in general, I just think it's going to the friction is going to be removed. Banks should be concerned just because, we're top, I don't know, 3, 4, privately held sort of a small business lender in the United States. And, there's 4,500 banks in the United States. We're not competing for their consumer loaning or their real estate portfolio or their treasury business. We're just going after their small business loans. And, it takes them 60, 90 days. It takes us 2 hours. So it's like, and that's what we're just focused on. If we can get the 2 hours down to 1 hour, or, what we're really working on is full automation where, an app just gets an approval, it's subject to like data latency, and it will, in 2 minutes you have an offer. So like, that's ultimately where I think we're heading in this business. And I think we'll get there. So it's just, it's just a matter of time.
Awesome. Ryan, really have enjoyed getting to know you a little and learn about what you're doing. Truly impressive stuff. Thank you so much for taking the time.
Thank you, Yanni. I really appreciate this conversation. It was great talking to you.